Hi, so welcome to this next video on the bonds. In the last video I have discussed about how bond pricing works, and in this video I will take the factors which affects the bond price. So just a quick revision first. We'll understand how the bond pricing, the bond price and the yield has a connection basically. So we know from our previous discussion that the price and the yield has an inverse relationship. Basically अगर एक ऊपर जाता है तो दूसरा नीचे आता है. आप इसको ऐसे समझ सकते हैं कि कोई भी बॉन्ड में जो भी yield है, that is the total returns which you get by buying that bond is we called yield, right? So जो yield is related to the price of it. So for example, if 100 rupees का bond है, उस पे 5% का कूपन है, but market में 8% का yield मिल रहा है, then certainly nobody will buy that bond, and in order to compensate that difference 3%, because मार्केट में उस बॉन्ड्स को बिकने के लिए, सप्लाई एंड डिमांड को एग्जिस्ट करने के लिए वहाँ पे दैट the price of the bond need to go down such that the yield, total yield of that bond becomes at least 8%. Okay, so the simple thing is this is core of bond pricing. That is, we have seen it is nothing but the present value of the future cash flow, whatever that is the bond will generate over the time of its life. So coupon and principal is the total bond price. So just as I discussed, yields are and prices are more inversely related. If yields go up, the price goes down. If the yield goes down, the price goes up. This is simple. Okay. Now we need to understand what are the factors which affects this bond pricing. There are multiple factors, and if I wanted to divide it into major two branch of it, so I will say one is where a central bank tweaks it. That is where we can say technically that organization of a country tries to regulate it. Okay, so that is like if somebody decides, okay, we need to raise the interest rate or the lower the interest rate, they can tweak it, and I will explain how. And the second branch, which I will call it as a supply demand side. So that is more like a dynamically decided by the market forces. So there are only two aspects of it. All the factors will fall into this two branch only. The first branch is where the Fed or the ECB or the RBI, that is the central bank of the country, tweaks the interest rate so that it affects the bond pricing. Other is supply and demand. So now let's understand the first part first. So how domestic interest rate affects the bond price. So domestic interest rate certainly is regulated more or less, or they try to regulate. So this interest rate is regulated by the central bank of this country. So for example, in our country it is RBI. So they decide the short-term rates. So you must be seeing quarterly that our central bank comes up and decides that okay, we will keep the rates same, or we will keep the rates, or we will cut the rates, or we will increase the rates, whatever is that. So if they, now what is that rate they talk about? So this is a short term rate. So you will ask, what is that short term rate? How short is short? So it is the lowest of the low. Basically they only decides on the overnight bonds. pricing. So what they do is they actually decide the repo and reverse repo rate. So what is repo and reverse repo? That is nothing but the interest rate at which RBI lends or borrows from the banks. So you see, as we do with the bank, as a customer, we interact our commercial banks or PSUs or ICICI Bank, SBI, HDFC, all are, these are commercial banks or state level or private level banks, right? So we deposit and we borrow the money from the bank. Similarly, the banks borrow and lend money to RBI. So lending and borrowing is a bit term just to understand the exchange between these two entities. Basically, RBI can print as much money as it can, but there is some rules and regulation which it incorporates in its charter or in its what to say. Basically, I would say that RBI doesn't work on whims and fancies. They jot down the rules, they think about it, that okay, what is necessity and what is not, but all the controls are with them. So if they wanted to produce lots of money, they can. If they wanted to suck out all the liquidity from the market, they can. But this doesn't mean that they will do that, because they take care of the country's economy and accordingly they decide what the interest rate or what the regulation should be. So now understand it. So if the central bank decides on the interest rate of the very short duration, that is overnight fund only, at which it can lend or borrow the money from the bank. Now from there it trickles down that how the other duration of the bonds prices affects. So basically the yield of other durations of the bonds, other bonds which are floated in the market or is actually traded in the market. Because see, what happens is, if let's suppose there is a bond which is traded at 8%, and for example, for simplicity, we will keep it overnight bond only. If it is now traded at 8%, for example, at 80% yield, tomorrow RBI comes and says that okay, we are increasing the rate to 9%. So what happens now? The old bond which were traded at 8% will become unattractive. So people, why would they will buy that bond or sell that bond? Because see, the problem is, if something becomes attractive, it means something is becoming unattractive to other side. So the other bonds which were already old and now became unattractive, it need to change something. So what it can change? The coupon rate is fixed. So it has to become the price need to go down, because now the yield has become 9%. That is one way. Okay, so when central bank raises rates, the existing bond with lower coupon rate becomes less attractive and prices fall. That is simple. And new bonds which are issued now will be at higher coupon rates, and because of that the yield rises. Now this is one lever of the central bank. Other lever, if I talk about, see, RBI or any other bank, they have multiple levers with them, but technically if we say वो हर 3 महीना पे आके just रेपो रेट एंड रिवर्स रेपो रेट का बात करते हैं, but in between that 3 months they do lot of work to regulate the yield of those bonds which are floating in the market. What they do is that they issue bonds, government bonds of various duration. Okay, so when they issue the bonds in the market, so what happens, a lot of people will buy, and they basically doesn't just sell it at a fixed price, it's always an auction. Okay, so if auction happens and the yield is getting decided, and let's say lot of bonds are getting pushed in the market, certainly the price will fall. If the price falls, the yield rises. So that means if RBI wants to raise the yield of the bonds in the market, or basically overall interest rate, they will start issuing lots of bonds. Does it make sense? So what happens is, from that, if they are issuing lots of bonds, that means they are sucking the liquidity from the market. So lots of institutions, retailers, borrower, people who will start buying the bonds. In order to buy the bonds, they have to put the cash in. So RBI will get the cash, and hence the liquidity which was available in the market gets sucked in by the RBI. And since RBI is issuing lots of bonds, so the supply of bonds are increasing, and the supply of bonds are increasing, the price will fall. If the price will fall, the yield will rise. Okay, so this is one side where RBI or the central bank plays with the interest rate of the bonds. Okay, now we come to the other side, that is demand supply in bond market. So this is simple, which I explained just now, that if the supply of the bond increases, certainly the price will fall, and if the price will fall, the yield will rise. So same thing, that supply can come from not only from government or the central bank, it can come from the corporates also. So for example, companies start issuing lots of bonds in the market. So what will happen? Lots of companies are now trying to raise money from the market, and hence they are issuing lots of bonds. And lots of bonds means supply of bond has increased, price will fall, yield will rise, right? Similarly, if there is higher demand, so let's suppose there are lots of institutions which are now buying the bonds. Why they do that? Now there are a lot of things why they will do that. So let's suppose there are uncertainty in the financial market. Okay, there is a risk perception in the market. If you see in the COVID time, when the risk was high, the uncertainty was high, lots of people tried to flock into the bond market, and you would see that the bond yield went up. Okay, so what happens is, in general, when the equity market or other markets goes down, or there is uncertainty in the market, you would see that the bond yield will rise. It is not always happens. There are two times in the history when it happened differently. So though that is not the topic which I am covering today. So this is simple demand supply in the bond market, which is, it can happen due to many reasons. If the uncertainty in the market increases, so the yield of the bond will increase. Now there are multiple things. Here comes that the liquidity premium. So if you see what is liquidity premium, so see what happens is, at the end in the market, lot of things move due to perception of the market, perception of the general people. So if they perceive, suppose Pakistan as a country has more risk in terms of financial stability or in terms of liquidity. So liquidity means, if I try to sell my bond, there won't be enough buyer. Okay, so if there are this kind of issue which is perceived, then arises the liquidity problem. So because of that liquidity problem, also when I am buying that kind of bond, I will demand more premium. Okay, so we call it liquidity premium. So okay, so if I wanted to just write it down in a single line, what is yield? So yield is nothing but whatever is the risk-free rate, you add inflation premium to that. Okay, so what is inflation premium? See, any country which is growing will have inflation. Okay, That means 100 rupees will become 105 in terms of purchasing power. So if I could buy something at 100 rupees today and 5% is inflation, in 1 year down the line, the same thing, if I need to buy, I will have to sell out 105 rupees. Now suppose if I am trying to buy a bond for 100 rupees and that bond is giving only 5% coupon, will I take it? I would say no, boss. Even if I don't do anything and just buy any commodity or something, that will give me 5% return anyway. Or if I don't do something, 5% inflation and 5% coupon actually becomes zero, net zero. So if I am putting my money right now, at the 1 year down the line, I will get 0% interest. So accordingly, I will adjust it and will say, no, I at least need 1% real return. So then if I need 1% real return, then inflation plus 1%, that is 6%, it will become. So I will demand 106 rupees. So that is kind of, one is inflation premium. So as per the country's inflation rate, my yield will have an impact because of that. Now third is credit premium. What is credit premium? So credit premium is something like the risk of non-paying, basically the credit default, or basically the default risk, we can say. So you would see that a lot of companies have a rating. For example, India has BB positive or BB ratings by the various agencies. US has now AA rating. AAA it used to have, some credit agencies now downgraded to AA. So this is nothing but a rating of risk. How probable this country is, in order to basically, if I say so, that okay, what is the probability of this country to default on the bonds or the sovereign bonds or any other kind of financial liability which they have. So that is one kind of risk. So that we say credit premium. So if that risk exists, for example, if a company's financial stability is not good, financial situation is not good, we will demand more premium, more yield, just because to cover that risk. So that is, we call it credit premium. So certainly if India as a country is issuing bonds and keeping everything same and compare it with US, the people will demand more yield from Indian bonds than US bonds. Okay. So third is liquidity premium, which we already talked about, that if there is no liquidity, if there is a problem in finding the buyers of my bond, if I wanted to sell, that creates a liquidity problem, and for that also I will raise the rate. So in total, the yield is nothing but whatever the risk-free rate plus my inflation premium plus my credit premium plus my liquidity premium. Okay, this is one side. Now this becomes a total, if I say it's a demand supply in bond markets. Now next comes is the cross country effects. Okay, so how it affects the bond market. See, there are two things. One is exchange rate between the countries, and another is capital flows, and these two are actually interrelated. So in terms of India, if you say, we have FDI and FIIs, okay, foreign domestic investor and foreign institutional investors. So these two routes, through these two routes, the money comes to India, okay, and it has an impact on our exchange rate. So now let's talk about first the interest rate differential, how it impacts, and then I will come to that how it will, the capital flow part. So if there is an interest rate difference is existing between the countries, the capital will move toward higher yield bonds. Think of it, if US is having 4% rate and India is having 8% rate, what will happen? Somebody who is in the US, they will say, okay, I will convert my USD into INR, invest in the India at 8%, and I will take back at the end of 1 year, give my money back at 4% to the US bank and keep my 4% profit, right? As a simple thing. So if there is an interest rate differential exists in the market, the capital will move towards higher yield bonds. But it is not that simple, where I am not talking about the FX risk, that is the exchange rate risk. This happens, whatever I explained, that 4% profit you can keep if everything remains same, which in the practical life never happens. For example, I have taken one example here, that if 10-year yield, that is 4% in US, and Germany has 2% 10-year yields, so whatever investor in euros will convert euro to USD by US bonds, and then it can hedge that. So another part is that you can now, okay, let me explain first that how you can profit from that, and then I will explain how you can hedge it. So the first part where I explained that 4% profit you can keep if everything remains same. Now if you are a little bit curious, you will start to think, okay, how can I manage all the other moving variables? For example, exchange rate is one of the moving variable. If I can control that exchange rate variable, maybe I can profit, maybe not 4% but something. Yes, that is what happens in the market. So what happens is people try to hedge the currencies exchange rate in the forward market. So what we'll do is so for example, a person in US who is eyeing this difference of interest rate, he will say, okay, I will borrow from US bank at 4%. I will hedge the currency. So since I am buying Indian rupee and converting my US dollar, so what I will do is, and I am keeping it for, let's say, 1 year, okay. So I will buy a forward of US dollar slash INR and hedge this conversion. So what will happen is, at the end of the year, just because you have, basically it is nothing but you are actually selling as soon as you convert it from dollar to Indian rupee, at the same time for future you want to convert it back to the dollar at certain already fixed rate. That is how forward market works. So you can hedge it using either future or using options. There are other options, lots of tools are available. Now if you do it and you are the first to do it, it's fine. You can lock that 4% or 3.5% or 3% that profit. But think about it, you are not the only one who is knowing that information, right? A lot of other people are also looking for this kind of arbitrage, and hence they will rush into it. There are a lot of institutions who are looking into it, and they will swiftly try to capture this arbitrage. And as soon as a lot of people rushes to it, what will happen? The risk, that premia which is existing as or I will not say premia, it's the arbitrage which exists in the market, will slowly disappear. So what will happen? How it will disappear? The interest rate remains the same, or little bit movement will happen, but the exchange rate or the forward rate will adjust in such a way that the arbitrage which we are seeing will not exist anymore. Okay, so this is what happens when the interest rate differential is there. So if 4% gap is there between India and US, you will see at the end of the year the currency movement happens in such a way that the 4% gap will disappear, and you will get no profit, no loss in that scenario. But in real terms, yes, just because there is a risk, there are other kind of factors are there, liquidity premium is there, the credit rate premium is there, you may get a little bit of profit if you try to invest in India instead of US. So this is one thing. Second is covered interest parity. Okay, I explained it basically just now, that if you hedge FX risk using forwards, then forward exchange rate sets no arbitrage condition. What happens is if you start buying a lot of forwards, the forward rates will go up, and the forward rates goes up slowly, it will, that balance will reach somewhere that you no longer find it attractive to buy it forward. That's how it happens. Okay, so this is cross country effects. Exchange rate and bond demand example. So that is what I explained basically. If there is a interest rate difference exists between two countries, then the exchange rate will move accordingly, so that the gap between those interest rate difference will eventually be, you can say it tends to zero, but since there are other kind of premium exist, so there will be a little bit of profit or loss you can expect from that movement. So I have written here, suppose US yield goes up sharply versus Japan. So Japanese investor might rush to buy US bonds to capture higher yields. This increases demand for USD to buy bonds, and USD appreciates in short term. But if they hedge FX risk, they must sell USD forward, which can depress forward rates. Getting? So how this one side USD appreciates and the other side USD forward will depreciate, and accordingly you will see that there are no more that arbitrage exists. So basically, conversely, what happens is if a country's currency is expected to depreciate sharply, foreigners demand a higher yield to hold that country's bond. That is risk premium. So if you intuitively think of it, certainly a company of which the risk perception is high, we will demand higher yield or higher premium for that. Now another part is that inflation and real rates and global flows. See, global investor, they care about real yields. Okay, so when we as a retailer we look at it interest rate or in the market, how the bond, how the banks or the post office or the RBI is giving the interest rate, we rarely think about the real interest rate. But is an organization, or when you are looking for inter-country or intra-country kind of scenario, the real yields basically the nominal minus the inflation. So the real yield becomes the deciding criteria. So if US inflation, now this is inflation, see inflation is always a backward looking data. Okay, so whatever happened in the past, that inflation we record and we get the data. But here we are talking about the future, the next 1 year, next 2 years, for what duration we are investing in that bond. Now that is where that comes, that the real yield is not about the inflation which has already clocked or will already printed in our, here we are talking about inflation which is expected inflation for the next year or next period of time on for which we are trying to gauge the yield. So nominal yield minus expected inflation is what we are talking about. That is real yield. If US inflation expectation rise while nominal yield stays constant, then what will happen is nobody will rush to buy the US bonds. And what will happen due to that? So if the US inflation expectation rise while nominal yield stays constant, that means the real yield falls. And if the real yield falls, the foreigner may sell the treasury, right? And accordingly the USD will weaken. So how the connection happening, you see how it is connected. The US inflation expectation, if US inflation goes up or expectation of the US inflation to remain high, the USD as a currency depreciates compared to other currency, and vice versa, right? If the inflation expectation is low, then the USD will go up. Emerging market bonds, for example our countries like India, Brazil, China, so high nominal yield but big currency depreciation risk. That's why emerging market bonds often have volatile foreign participation. So certainly there are, if the inflation is not, we are not able to gauge, or if we are not able to properly estimate the expected inflation, we will always try to err at the risk side. Basically we will say that okay, I will take the maximum of whatever is expected, and I will say okay, this is it plus a little bit premium I will ask for that bonds pricing. So that's why if you see emerging market bonds will have more yield compared to developed markets. So in a nutshell, I have what we have discussed here is that the bond pricing, how the bond prices moves. So I would say in a way that the shorter duration the bond is, more and more it is manageable in terms of how much expected yield it will generate. So in a nutshell, I would say that if we are looking to invest in bonds, try to minimize the duration of the bonds, because more the duration, more it depends on the supply demand side, because the central bank and the inflation expectation or expected inflation, all these are very much can be predicted for a very short duration of future, or maybe next 1 year, next 6 months. Nobody can predict it for the next 10 years or 5 years, right? If you are okay with the volatility, then only you should go for a longer duration bond, because it is more like a equity market. It becomes, it will mostly, the price will mostly driven by lots and lots of factors: political scenario, inter country exchange rate, inflation rate, what kind of risk premium now getting adjusted due to war, due to some political risk, hundreds of it. So it is, at least for the retailer part, we are not able to, it is better always to shorten the duration as much as possible, unless we are investing for very long term and it is for a specific goal. See, what happens is, if you hold the bond till the end of it, there is no problem. The problem arises, the volatility and everything arises only due to if you want to exit prematurely through the secondary market. If you buy the bond, and let's say if right now 4% interest rate is there in US for 10 years bond, you buy the bond, hold it for 10 years, you will get 4% interest rate year on year. That's it. In the meantime, the interest rate, wherever it happens, wherever it goes, doesn't matter. You will get it. But then where the risk is, let's say if inflation is 8% for the next 10 years, you actually lost money right there. That's the risk. If it can work in your favor also, for example, let's say if the interest inflation went to zero, almost zero, then your real yield becomes 4%. And at that time, now you have an option. You can either hold it. In that case, you are getting the money anyway, but you have the option to sell it in the market. People will buy it because now the real yield in the market may be 2% and your bond is giving 4%. So your price will increase in such a way that the real yield will be 2%. And just because you are holding it for the higher duration, the total effect of whatever the benefit you had for the next whatever remained year is, it will start reflecting in your price. And that's the beauty of it, that you can cash in the whole premium right now, right away, and encash it and go on. So see, it is something like I would say, if you are aware about option wheeling or kind of a put option buying or something like that. So basically you buy the bond, in case it goes down, no problem. Okay, you hold it till the end of that duration. In case it goes up, that's your advantage. You can sell it and exit. So that's the nutshell for a higher duration bond. On the other side, if you don't want to play with that volatility of the bonds, you always try to go for a lowest duration bond where it matches with your goal duration. Okay, that's it for today. Thank you.